Next month will be my 6-year anniversary of trading options. And there's 4 things that I really wish I'd known before I'd gotten started, which would have not only saved me a lot of money, it would have saved me a lot of stress along the way. So in this video, I'm going to share with you what those 4 things are and show you how to avoid them so your options trading journey can not only be a lot more profitable, it can be a lot more peaceful and stress-free as well. Now, if you don't know who I am, my name is El-Gorr. I'm the founder and CEO of a company called Freeman Publications. You may have seen some of our books on Amazon. And what we do is we help everyday people invest their money better so they can live a more financially free life. So without further ado, let's get into the video. I'm going to share with you the 4 things that I wish I'd known before I started trading options. Okay, so here's what we're going to get right before you start trading options. And here's what I wish I did before I actually started too. The first is deciding why you're doing this. And this is kind of overlooked, but really, really crucial. A phrase I really love, there's 2 phrases actually here. Common sense isn't always common practice. And the second one, which is from one of my original mentors in this field, was the kind of people attracted to trading are usually the type of people who shouldn't be trading. And what he meant by that is a lot of the time, the kind of people who are attracted to trading or options or really any sort of financial sphere tend to be get-rich-quick types. And if you're looking to trade options as some sort of get-rich-quick endeavor, you're going to have a bad time. Just as I did when I first started out, because I was drawn to strategies which were marketed as kind of get-rich-quick, big gains overnight, super easy, just click 2 buttons, everything will be fine. It doesn't work that way. I learned that the hard way. And so going into this endeavor with the right expectations is first and foremost the key to success. You don't want to be the guy who, I found this on Wall Street Bets. It's a great resource if you want to find out what not to do. I'm 35. I've never made a profit trading since I started 5 years ago. I still don't know what delta, theta, or 5 times earnings means. I'm just a gambling degenerate hoping for that jackpot play that will change my pathetic life. Now, hopefully, if you're watching this, your life is not pathetic. And judging by the people I speak to all the time, you don't have a pathetic life. You just want to improve a little bit. You can't be trading for 5 years and still be making losses. If you have, you've probably gone into this with the wrong expectations, like this gentleman here. So first of all, have reasonable expectations. Or, this guy who managed to take a $5 million account, and this was in February of 2021. We had 9 incredible months from February to about November 2021. He turned a $5 million account into $13,000. Don't be that guy. So who should trade options? Well, really, I think you need 3 things in place before you do so. Number 1, you need a basic financial plan. This cannot be, if you're just starting out, this cannot be the only thing you've got going on. Chances are it's not going to work as your sole source of income when you're just starting. Unless you've magically got $3 million just to sit on, it ain't going to work. So what you want in place before you start trading options, long-term investments, a small amount or ideally no consumer debt, and a fix on your spending habits. If you're spending more money than you're taking in, no amount of options income is going to fix that problem. You've got to fix that in your life beforehand. Because believe me, I've seen people do it where they're making 30, 40, 50,000 a month and they're spending just as much. And the spending can always catch up. So make sure you've got a fix on your spending habits first. Once you've got this in place, be reasonable. Once again, I keep saying that. This is great for extra side income. Straight away, you should not be looking to replace your job with this. And also, this is one of those disciplines that is going to challenge you intellectually. So you should be looking for a challenge. I always describe trading options as solving challenging but solvable problems. And if that's the kind of person you are, then this is a great discipline to get into. This is a skill. You can learn it, you can improve over time, and given enough time, you can master it. with enough time, enough repetitions, and enough feedback loops and iterations based on what you're doing, then you can absolutely master this, regardless of where you start from. So that's the first thing you really need to get sorted. The second is kind of logistical. You just need to decide what account you're going to use. This really is just to avoid unnecessary taxation and headaches. Certain accounts can be more beneficial, especially with certain strategies. I said in the previous video, don't pay taxes and fees unnecessarily. I'm going to reiterate that here. For most risk-defined option strategies, so that's the things like the wheel, which is selling cash secured puts and covered calls. That's my personal favorite. Things like credit spreads as well, which are risk-defined. A Roth IRA is likely going to be the best place to start because you can allow your gains to compound tax-free before you begin withdrawals. Because options profits are qualified withdrawals, and that's assuming you meet the standard criteria. Of course, I am not a tax advisor, but if you do things properly and you have everything else set up correctly, you will be able to withdraw your gains tax-free after the age of 59 and a half. However, if you do just want to dip your toe in and just get a feel for how this all works, just use a regular brokerage account. Don't overcomplicate it. You don't need to set up an LLC or anything like that. Just spend the energy focusing on trading. Don't try and run before you can walk. Third part, deciding when to start. It's kind of a weird one, but allow me to explain. Paper trading is a bit of a misunderstood topic. Now, I speak to a lot of people and they say, you know what, I just want to paper trade for 6 months and see how I do. Completely reasonable to want to do that. However, paper trading can only teach you so much. It will teach you the mechanics of a strategy, how to actually enter the orders in your brokerage account, how to actually understand where the profit and loss on a trade is going to come from. That's useful, but that's about where the usefulness ends. I've got a screenshot here, which is someone who's, just paper traded and got their annual returns at 830,000%, whatever it may be. And look, it does not work that way in the real world. Because here's what paper trading does not teach you. It doesn't teach you anything that comes from skin in the game. Mostly on the emotional and mental side of trading. Fear, greed, anxiety, stress, euphoria, despair. The entire emotional fluctuation, paper trading is not going to teach you that. It's easy to be emotionless when the money isn't real. You can have a $500,000 paper trading account, but you'll learn a lot more about how you react emotionally with a real $50 loss. And I've seen people who have $1 million accounts, but when they're faced with a $30 loss, they're like, oh God, this is awful. I can't deal with this. You probably shouldn't trade if that's you. And the big secret to trading success is not one particular indicator or strategy. It's emotional discipline and knowing when to stick to a plan. Spoiler alert, that's how you make this work for you. The one other thing that paper trading doesn't teach you that I don't hear people talk about often is liquidity. Because if you're paper trading, your orders always get filled at the exact price you want. Once again, in real life, that doesn't happen. If you're trading a stock that's not very liquid, you may have difficulty getting orders filled. You may get them filled at prices that aren't the prices you want. And so you're going to have to deal with that challenge. But once again, in paper trading, it doesn't happen. This is why I always encourage people to trade with real money from day one. And if I had to start again, here's what I would do. I would do the exact same thing I did when I started, which was start with a real account with a small bit of cash inside. Now, I personally started with a little bit over $4,000 in the account. It was £3,250, which at the time is about, well, now it's about $4,000. At the time, the exchange rate was a little bit better. So just over $4,000. Don't use margin. Just don't do it. You will more than likely blow up your account if you're trading with margin from day one. If you're not familiar with what margin is, it's where you just borrow money from the broker to trade. It allows you to trade bigger sums without having the cash up front, but it does expose you to more risk. And even if you have a huge chunk of change just sitting there, let's say you just got $1 million right now sitting in a money market fund and you're like, I don't know what to do with it. Well, just start with a smaller amount. You can make mistakes with less on the line, and you can always add to that account over time. Trading options is a marathon, not a sprint. The reason I love this field is it's something you can do for 10, 15, 20, 25 years and continue to get better over time. It's not something that you can pick up in 6 months and become a trillionaire. Once again, it goes back to that first point I made, having reasonable expectations. But if you are in this for the long game, this can be a very, very rewarding field to get into. And the fourth part is really deciding which strategy to use. Because in the beginning, you only want to do one. Worst thing you can do is think, okay, I'm going to start, let's try and learn 7 different strategies at once. Doesn't work that way. Just pick one, learn how to do it, and learn how to do it well. Do that for your first 5 years. Then, if you're still around and you still want to challenge, maybe consider adding in others, but just pick one to begin with. First of all, anything marketed as easy money or big money in big chunks is going to likely lose you all your money. Easiest example of this is selling naked calls, which is basically selling calls on options where you do not own the stock. So you have unlimited downside exposure. It is marketed as easy money, and I love this quote. I found this on Wall Street Bets as well. Shout out to Wall Street Bets, a lot of inspiration for this video. Selling naked calls is like selling drugs, easy money till you're dead, because there's a very high blow-up risk, because when those trades go wrong, they go really wrong really quickly. So anything marketed as easy money, stay away from. The second is think about your constraints. How much time do you have to spend doing this? If you're still working full time, then obviously you don't want a strategy that's going to take 8 hours a day. Like scalping, for example. Scalping is very popular, but it does mean you're now committed to be at your screen at the exact same time, Monday to Friday. And that time is going to be usually during the first half hour or so of the market open, which if you're working a 9-to-5 job is also going to be during working hours. So that's going to be really difficult for you to stick to. You can sell 0 DTE put options, and you can do that every day, but are you prepared for the wild emotional fluctuations that you're going to have every single day? Once again, these strategies are not particularly passive or hands-off. So for most people, they're not going to work. For me personally, I like doing the wheel, which is a combination of selling cash secured puts and covered calls, because I can comfortably do it in about 4 or 5 hours per week and choose when during market hours that I actually do it. For me, I do most of my trading between 5 and 6 p.m. UK time. So that's 12 to 1 p.m. Eastern. Middle of the day in the market, it tends to be towards the end of my working day. So it just fits into my schedule perfectly. But if I can't make it during those times, that's fine. As long as I've got some time between 9:30 and 4 p.m. Eastern, it's good. So for me, works really well around my schedule. The other part of this that I don't see too many people talking about is what complementary skills are you learning as part of the process of learning to trade options? So some strategies, for example, exclusively rely on technical analysis. And there's nothing wrong with that. But technical analysis does have a pretty steep learning curve, especially if you now have the additional constraint of you must act quickly, like a scalping strategy, for example, because you have to get your orders in. So not only do you have to learn something new, you have to learn it in a very time-intensive manner, which can be quite stressful for a lot of people. Other strategies may afford you the ability to take your time, thoroughly analyze trades without that gun to the head of you need to act in the next 5 minutes. And this is also where knowing yourself comes into play as well. Because if you're the kind of person who maybe doesn't do too well under pressure, those strategies won't be right for you. whereas something like the wheel may be easier to fit into your schedule. The other part of this is, well, what percentage of the time does the strategy actually work? You know, selling volatility, for example. In the middle of a bear market, these strategies get very popular. And so most of 2022, parts of 2020, selling volatility, very popular strategy. But then you've got to go literally years at a time without making any money. 2019, 2021, 2023, 2024, selling volatility was near useless. Almost guaranteed you would have had losing years. And the fact of the matter is, emotionally, it's really difficult to go through those really long barren periods. Michael Burry, great example. Everyone loves to talk about Michael Burry, but for every Michael Burry, there were 50 people who had the same idea, but not the stomach or the risk tolerance to lose money for 2.5 years in a row before the trade actually came to fruition. So people like to rag on strategies that work best in bull markets. You hear it all the time. Oh, this only works well in a bull market. The fact of the matter is, the majority of the time, we are in a bull market. Roughly 8 out of 10 years are green years. And just because returns are lower during market corrections doesn't mean that the strategy itself doesn't work. So for me, once again, strategies that work for me are strategies that do work better during bull markets, because guess what? I like to see money coming in most of the time. But just because they work better in bull markets doesn't mean you're going to lose all your money in a bear market. There are steps you can take to mitigate the risk, take some of the risk off the table, or hedge your portfolio. I should probably do a video on that. I'll do a portfolio hedging video using options. Back to our regularly scheduled programming, complexity does not always equal higher returns. You know, strategies like iron condors, for example, butterfly spreads, they get marketed as more advanced. You know, you do credit spreads, but then you start doing condors, you can do butterflies. More advanced doesn't mean more money. What I found when I started trading things like iron condors was I was spending a lot more time actually doing the strategy. I was spending a lot more time trading, but I wasn't making more money doing it. And in fact, I was spending more time and it was more stressful for roughly the same return. So why would I take on that extra stress and time without being additionally compensated? It doesn't make sense. So just because something is quote unquote more advanced doesn't necessarily mean it's better. I like simple strategies, which is why I exclusively do the wheel now. First of all, it aligns with my goals. Remember step 1, decide why you want to do this. I wanted consistent income from a portion of my portfolio that I can compound and then withdraw when I need it. It's tax efficient because you can do it in a Roth IRA. If you're in the UK, you can do it in a SAS. You can also do it in a SIP. It's just a little bit more complicated. The other part is, and this is something about the wheel that I don't see too many people talk about, because as part of the wheel you do get assigned the position and then you do end up owning the stock, it forces you to take greater interest in the companies you're actually trading. It forces you to be more diligent and it forces you to level up your overall financial knowledge, because you've got to have some sort of fundamental understanding of what it is you're trading. So for me, the wheel has always been a healthy balance between some technical analysis, but also understanding the fundamentals of companies that I'm happy to own if I get assigned on the position. So that's why I like it. It also cultivates a disciplined mindset. I always say this, the wheel is a simple strategy. It's not easy. I don't think anything worth doing in trading or investing is easy, but it can be simple. So instead of chasing momentum or, having to second guess yourself and act within 2 or 3 minutes, you rely on a very repeatable, reliable sequence of events. You sell your puts. finishes in the money, you get assigned, then you sell your calls. Once your calls exercise, you take your profits, then you do it again and again and again. Repeatable, reliable, consistent. And each step is deliberate. There's no impulsiveness. There's no need for revenge trading. There's no massive highs and lows either. So it's a nice, steady, churning along strategy. And if you want to know more about the wheel and how it works and how I actually trade it, then the video in the bottom left right now will be the perfect video for you, because it's a full tutorial of how I trade the wheel and how in 2024 I made 36.5% returns doing so. So I hope you enjoyed this video, and I will see you in the next one.